Hello everyone. Today we're going to talk about the revenue recognition principle. Now, before I rush ahead, what is revenue? Revenue is an increase in resources generated from the sale of goods or services. The revenue recognition principle states that revenue is recorded when they're earned, not just when cash is received. Now, revenue is recorded in two ways. Deferred revenue is when cash is received before a good or service has been consumed. Accrued revenue is when a good or service is consumed before cash is received. Now, meet Fred. He really likes travelling and decides to book a flight to Europe. Fred purchases a $1,500 flight on the 1st of April which will depart on the 1st of May. This scenario is deferred revenue as the flight was paid before the service was provided to Fred. Since the revenue recognition principle states that revenues are recorded from the sale of the service, not just when cash is received, the revenue is recorded in May, not April. This is because Fred consumed the airline service in May even though he paid in April. Here's the journal entry when the airline receives cash in April. Cash is debited to show an increase in cash paid for the flight. Unearned revenue is credited to increase unearned revenue, showing the service still needs to be provided. Here's the journal entry when the airline earns the revenue in May. Unearned revenue is debited to decrease unearned revenue, inferring the flight has been provided. Service revenue is credited to increase service revenue, showing that the flight service has been provided. Now, let's look at a second example. Let's meet Johnny. Johnny is a licensed painter who paints the inside of his clients' houses and leaves a bill afterwards. Johnny paints Andrew's house just in time for Christmas. He performs his service on the 1st of December, leaving a $2,000 bill on the 1st of January. This scenario is accrued revenue, as Johnny paints Andrew's house before he receives the cash. Now, according to the revenue recognition principle, the revenue was earned in December, not January. This is due to performing the service in December, even though he didn't receive any cash until January. Now, here's the journal entry when Johnny earns his revenue in December. Accounts receivable are debited to increase the amount of money that Johnny is owed. Service revenue is credited to show that Johnny has performed the service. Now, here's the journal entry when Johnny receives the cash from Andrew in January. Cash is debited to show that Johnny has received the $2,000 from Andrew. Accounts receivable are credited to show that the $2,000 Andrew owed to Johnny has now decreased. So, to summarise, revenue is recorded when it's earned, not just when cash is received. Deferred revenue is when a good or service is consumed after the cash is paid. Accrued revenue, on the other hand, is when good or service is consumed before the cash is paid. And the revenue recognition principle states that revenues are recorded when they are earned, not just when the cash is received. Thanks for listening, and I hope you have a better understanding of the revenue recognition principle.